When might it stop? Let's ask the star analyst Dan Ives. He covers Tesla shares for Wedbush, has an outperform rating, something it has not done lately, to say the least. Welcome. It's good to see you. It's stunning. I'm looking at it right now. It's like a double take. It broke 110. Okay. It's going to finish below that today, barely hanging on to 109, nearly a 12% decline. I feel like we've had this conversation a lot lately, and every time we do, it's for several percentage points lower than the prior time we had the conversation. What in the world is going on here?
Well, I think Musk set off the 5-alarm fire. You know, that really started this in terms of the Twitter train wreck and what's really been a black eye for Musk and a black eye for Tesla. And now the demand, the second leg, demand starting to soften in China. China, that's the hearts and lungs of the Tesla story. So right now, that 1-2 punch is really a perfect storm for Tesla stock. And I can tell you, institutional investors calling me are as white-knuckle nervous as I've seen them going back 4 or 5 years.
Okay, so you're speaking to institutional investors who are calling you and saying, okay, Ives, you continue to tell me to buy the stock. I got to outperform on it. What should I do? What do you tell them?
And then it's like, where's the stock go? Like, so which stress test? Like, is it $5 earnings power? Is it less? You know, could this ultimately go lower? Could this trade 75, 80 hours?
They're asking you those questions.
And those are the questions they're asking me, because right now we're in basically uncharted territory because of a self-driven, what I view as a $600 billion mistake when you combine all that Musk really started here.
Well, how low can it go?
So look, we believe $5 of earnings power is really, even when you stress test it, ultimately I think where Tesla goes, you know, in terms of 2023. You look at units, worst case, we think potentially 1.7 to 1.8 million in terms of where units could go. I think you're starting to get to a point here, you get to 95 to 100 hours, we start to get to a point where that is almost, you are baking in that they would probably do $4.50 of earnings. So I think we start to get below 100, we start to get to, you know, what I view as extreme panic in the name.
I mean, when you have an outperform rating on the stock and you have an outperform, you know, way up in the clouds, and you have an outperform as it comes back down to earth, people start to question your credibility on the name. I'm sure you're thinking about your reputation on this stock. How does that factor in how you're thinking about it today, and whether that will cause you to change your rating on it simply because the goalposts seem to have moved?
No doubt. And I can tell you, in decades of covering tech stock, it's the nature. Going up, you're a hero. Going down, you know, obviously it continues to really be targeted on the back. I view it as, is this a, so this is what I asked them, is this a transformational play on electric vehicles, where today it's 2.5% of the U.S. auto market? I believe it is. So
still believe it is?
I truly believe that ultimately 70% of this sell-off is really Musk, Twitter train wreck driven, rather than core fundamentals. Now, with that said, damage is done, as we've talked about. Black eye, how do you ultimately start to regain your footing? If they, what I believe, could get to 35, 40% growth in a worst case going into next year, you talk about what could be $5 earnings power, then I think we look back in this period and be like, they was way oversold on the downside. But no doubt, Scott, this is definitely what I view. It's a fork in the road. It's a moment of trust for Musk, you know, in terms of where we are.
But you're telling me of all the issues, the competition, the China shutdowns, Elon selling, it's the Twitter distraction that is the bulk of the selling. I didn't even mention the fact, the re-rating that stocks like this have taken in a non-zero interest rate environment. And this was one of the poster stocks that probably benefited greatly from zero interest rates, and a frenzy in the market that happened as a result. A stock that probably never should have been $1.24 trillion in market cap at its peak, and the jury is out as to whether it should be where it is now, which is now smaller than a Walmart or an even JP Morgan.
Yeah, and I do believe it, even though we have obviously the macro, multiple compression, everything else. If you look at the Musk Twitter situation, he did what no short could do, no bear, no conspiracy theory, self-driven. The $44 billion ultimately led to what could be another $500 to $600 billion, and that's why this is going to go down as just a historically horrific move for Musk. Then now he needs to course correct, otherwise this is just going to continue to fester.
What does that mean, course correct? I mean, what stops the selling? What does he need to do?
Well, I think there's three things. One, a CEO of Twitter in the first 2 weeks of January that's truly a CEO, not just a figurehead and a yes person. Two is that to actually, with the board as well, coming out with this, in terms of not selling stock, not just saying it, because that's the boy that cried wolf, actually saying he's not going to ultimately sell stock and putting some actually paper behind it.
Okay, let me ask you this, okay, because he's just recently said that he's not going to sell anymore for the, the foreseeable future. I think we can say, do you believe him?
Well, it's a Pinocchio moment because ultimately he's said it many times, continue to sell. Now, board does have to get involved, and there has to be at least a 10b5 plan. There needs to be something so investors understand what the goalposts are with selling. And the third, they need to come out with guidance, rip the Band-Aid off. Don't give lofty numbers they're going to have to continue to cut. If they do those three things, then the stock ultimately bottoms.